Ultimate Guide Module 5, Understanding Managed Care. Learning Objectives. To demonstrate an understanding of managed care health plans by defining managed care and managed care organizations, identifying types of managed care plans, identifying health maintenance organization models, defining consumer-directed health plans, distinguishing between health savings accounts and health reimbursement accounts, defining managed care carve-outs, and Medicare Advantage plans. Module 5 Self-Assessment. Question number 1. Obtaining a prior authorization is part of the blank process. Option A, concurrent review. Option B, prospective review. Option C, retrospective review. Option D, introspective review. Question 2. Authorization and certification may involve both patient access services and case management utilization review during the retrospective review. Option A, true. Option B, false. Question number 3. HMOs may be the most common type of MCO. Option A, true. Option B, false. Question number 4. There are 4 basic HMO models. Option A, true. Option B, false. Question number 5. There is no difference between a HSA, HRA, or a high-deductible health plan. Option A, true. Option B, false. Question number 6. All Medicare beneficiaries have Medicare Advantage plans. Option A, true. Option B, false. Managed care. What is managed care? Managed care is defined as means of providing healthcare services within a defined network of healthcare providers who are given the responsibility to manage and provide high-quality, cost-effective healthcare. The term is used to include preferred provider organizations, PPOs, and their hybrid organizations such as exclusive provider organizations, EPOs, and point-of-service plans, POS, forms of identity insurance that incorporate pre-admissions, certification, and other utilization controls, and health maintenance organizations, HMOs. Managed care involves the management of utilization and reimbursement techniques that aim to control cost while assuring quality patient care outcomes. The way managed care attempts to control cost is to focus on the price, volume, and intensity for service provided to people covered by managed care plans. Managed care is characterized by managing cost and care delivery through contracted providers, management of benefits for services received from contracted and non-contracted providers, some types of authorization, claims, and quality systems. Managed care is also characterized by the management of patients' utilization of healthcare services. Organizations that deliver care through health plans that incorporate utilization management techniques are also referred to as managed care organizations, MCOs. Authorization, certification, and verification. What is authorization? Authorization is a health plan system of approving payments of benefits for services that satisfy the payer plan's requirement for coverage. Pre-authorization is the process of obtaining approval from the coverage or health insurance provider before performing procedure, service, or medication. Often requires clinical documentation to support why the procedure is being performed and determine if it's medically necessary and if the service will be covered. The various statuses of an authorization are approved, pending review under clinical, and denied. Approved authorization does not equal a guarantee of payment. Most insurance representatives will make a statement like this before providing information. A quote of benefits and/or authorization does not guarantee payment or verifying eligibility. Payment of benefits is subject to all terms, conditions, limitations, and exclusions of the member's contract at the time of service. Why is authorization important? Prior authorization is just one of the ways insurance providers work to address the rising healthcare costs. Hospital and technology costs and the increased use and overabuse of healthcare services contribute to the rising healthcare costs. As healthcare costs go up, healthcare premiums also go up to pay for the services provided. Prior authorization helps hold down the costs of healthcare by determining if procedures or services is included in the coverage before it is performed. It also confirms that the procedure or service is medically necessary. It also helps to ensure accurate and timely processing of claims. It also determines if the medical provider or facility is in-network or out-of-network. What is certification? Certification is a process to inform insurance companies that a patient has a hospital stay. Pre-certification is a requirement that the plan member or the physician in charge of the member's care notify the health plan and gain approval in advance of the patient undergoing a course of treatment, such as a hospital admission or a complex diagnostic test. There are three various basic statuses for pre-cert, pre-auth, authorization, or certification. Again, they are approved, pending, with needing clinical, or denied. What is benefit verification? Verification is the process of making sure that all necessary information is present and accurate at the point in time. Once verification duration lapses, the information will be needing to be re-verified in case of any information has changed since the previous verification. The following items should be checked during the verification process: the policy, the group number, eligibility, is the policy still active or is it terminated, what the effective date is, what the termination date is if applicable, the coinsurance, the deductible, the out-of-pocket, the lifetime max, and the copayment. For workers' compensation and motor vehicle accident, it is important to obtain the following information: the policy and coverage information and ID, the mail claims to address, the adjuster's name, and the contact number. Utilization management. What is utilization management? A key goal of an MCO is to develop relationships with providers that will permit the MCO to influence practice patterns, either contractually or by using financial incentives. The intent is to lower the healthcare costs by managing utilization of healthcare services. There are three approaches to utilization management. They may be used by MCOs separately or in combination: prospective review, concurrent review, retrospective review. Prospective review from the patient access perspective. Prospective review means that the case is reviewed before it happens. Pre-certification, pre-authorization activities may involve both patient access services and case management. Examples of prospective review include pre-certification, pre-authorization of a patient's account. These processes call for an active coordination with referring providers to ensure that the clinical information required for authorization is provided to MCOs. Concurrent review. Review from a case management perspective involves utilization review by case management. Examples of concurrent utilization review include length of stay reviews, authorization status reviews, proactive discharge planning, case management for catastrophic or chronic illnesses. These techniques call for active coordination of care that result in positive outcomes that are cost-effectively achieved. What is utilization management? Concurrent review continued. Concurrent review involves managing utilization during the course of the hospitalization or chronic illness. Concurrent utilization management includes continuation of looking at the status of the pre-cert or pre-authorization for non-covered urgent encounters, referrals to specialists, second opinions for certain procedures. The purpose of these reviews is to determine that the care received is appropriate and will be delivered in the appropriate setting. Retrospective review. Retrospective review by the managed care organization occurs after a patient has been discharged. There are two objectives for retrospective reviews. The first is to determine the appropriateness of care and/or the claim for a particular case by reviewing the medical record as well as the claim. The second is to perform a pattern analysis by aggregating data for all the cases so that decisions can be made regarding effectiveness of outcomes for certain protocols or providers in order to establish a preferred protocol or provider for further future referrals. Managed care continued. MCOs provide or arrange for the delivery of healthcare services in accordance with the terms and provisions of a contracted health plan. MCOs may either assume the financial risk for some or all of the cost of delivering healthcare service or contractually transfer this risk to providers. HMOs may be the most common type of MCO. An HMO provides offers or arranges for coverage of the designated health services needed by plan members or a fixed prepaid premium. Under the Federal HMO Act, an entity must have the following three characteristics to qualify as an HMO: an organized system for providing healthcare or otherwise assuring healthcare delivery in a geographic area, an agreed upon set basic and supplemental health maintenance and treatment services, a voluntary enrolled group of people. A health maintenance organization, HMO, works like a club for both patients and healthcare providers. Subscribers to an HMO receive medical services from participating physicians, clinics, and hospitals. An insurance company sets up an HMO and gets a group of doctors to participate. The insurance company and the doctors agree on certain costs and charges, which lets the insurance company control the expenses and provide lower prices. HMOs strive to control healthcare costs by requiring members to receive service at designated facilities and by promoting wellness by regular physician checkups. All services except those provided in life-threatening situations must be provided or approved by the participating physician. Typically, members must select a primary care physician, PCP, affiliated with the HMO who is responsible for oversight of the patient's entire health care. The PCP must approve any non-emergent services. Examples of HMOs most commonly seen are Blue Cross Blue Shield, Cigna, United Healthcare, and Aetna. There are four basic HMO models. Staff model. In this model, the HMO employees and compensates the physicians who see patients in HMO facilities. All premiums and other revenues accrue to the HMO. Group model. In this model, the HMO contracts with a group and its physicians may be organized as a partnership, professional, corporation, or other association to provide healthcare services to members of the HMO. The HMO compensates the medical group. Individual Practice Association Model, IPA. In this model, the HMO may contract with a physician group that in turn contracts with individual physicians. Alternatively, the HMO may contract directly with the individual physicians. IPAs are in general much more loosely structured than other group models. Network model. In this model, a health plan contracts with various physician groups that are organized in single specialty, multi-specialty groups, or primary practices to provide defined health care services to members over the contract term. PPO is a type of MCO that allows the covered persons to choose to receive service from either a participating or non-participating provider. The PPO contract with a network of providers who will receive a discount in exchange for steering patients to the network. Covered members receive a higher level of benefits when care is delivered by a network provider. POS. Point of service plans are a type of MCO that allows a covered person to choose to receive service from a panel of HMO providers or go outside of the panel with different benefit levels and sometimes different coverage is associated with the use of participating panel. POS plans typically require access through contracted or employed primary care physicians. Most health plans have POS products. Examples of possible POS products are Aetna POS, Cigna POS. Independent Practice Associations, a voluntary cooperative of physicians who want to maintain practice autonomy while formally aligning to negotiate with MCOs to provide healthcare services, including managed care contracts. Physician Hospital Organizations, PHOs, is an association of a hospital and the physicians and the medical staff of that hospital. Its primary purpose is to negotiate with MCOs to include both hospital and its physicians on the MCO panels of providers. Consumer-directed health plans. With the passage of Medicare Prescription Drug Improvement and Modernization Act of 2003, which encouraged the implementation of health savings accounts, the use of consumer-directed health care has steadily increased. Consumer-directed health plans, CDHPs, are intended to make consumers more cost-conscious. CDHPs shift the risk or the cost to the consumers of healthcare. Patients are encouraged to thoroughly look at the financial incentives to become better educated about their healthcare. They are now expected to consider quality, cost, and convenience before choosing their providers. Medicare Advantage, Part C. Medicare Plus Choice, aka Medicare Advantage, also known as Medicare Part C, are plans that may include health maintenance organizations, HMOs, HMOs with a point of service option, POS, provider-sponsored organization, PSOs, and preferred provider organizations, PPOs. These types of plans involve a specific group of doctors, hospitals, and other healthcare practitioners who provide care to the members of the plan. Medicare managed care plans provide all the services covered by both Part A and Part B. Most offer a variety of additional benefits like preventative care, prescription drugs, dental care, hearing aids, eyeglasses, and other items not covered by the original Medicare plan. Costs for these are usually extra benefits among various plans. Medicare private fee-for-service plans. The private insurer, rather than the Medicare program, decides how much it pays and how much the beneficiary pays for a particular service. The beneficiary may go to any doctor or hospital that accepts the items of its plan's payment. Consumer-directed health plans. What is a consumer-directed health plan? Consumer-directed health plans, CDHPs, are intended to increase the consumer awareness about the healthcare costs and provide incentives for consumers to consider costs when they're making their healthcare decisions. CDHPs include health plans with high deductibles along with consumer-controlled savings accounts or health saving accounts, HSAs, for healthcare. There are two primary types of healthcare saving accounts: health saving accounts and health reimbursement accounts. With CDHPs, consumers have greater responsibility for managing the costs. They also emphasize the patient is an individual responsibility and ownership. HRA versus HSA. Health reimbursement accounts are employer-established accounts that provide non-tax funds that employees can use for medical expenses, are funded exclusively by the employer, are usually nominal accounts. Employers do not add funds to the account until liabilities are incurred. Employers may restrict the types of services for which HRA funds can be used. Unused balances may be rolled over for future use. Health reimbursement accounts are not portable if the employee leaves a job. Unused balances often revert to the employer. Employer plans can stipulate that the funds can be used for healthcare expenses, but not as cash, incurred after retirement or termination. Health reimbursement accounts can be used for paying premiums for medical plans, including COBRA coverage. There is generally no limit on the employer contributions to HRAs. HRAs are often offered with HDHP but are not required. HRAs can be offered without a medical plan. HRAs may be limited to retiree benefits or other uses. Health savings accounts. HSAs are tax-exempt accounts established by an eligible individual. Health savings accounts criteria. HSAs are covered under the HDHP that meets federal requirements. They are not covered by plans that are not HDHP. Health saving account beneficiaries are not entitled to benefits under Medicare. Health saving account owners may not be claimed as dependents. Individuals, employers, and others can make contributions to health saving accounts. Health saving accounts can be used for qualified expenses of individuals and dependents. HSAs belong to individuals and are portable if change in job. Contributions can continue only as long as they're eligible. The individual is the beneficiary of the investment income. Health saving account funds generally cannot be used to pay for health insurance premiums except COBRA. When the individual is unemployed, or coverage for people over age 65 other than Medigap. Requirements for HDHPs offered with HSAs. Deductibles of at least $1,050 for single coverage and at least $2,100 for family coverage. Annual limits of an out-of-pocket expense for in-network services, $5,250 for single and $10,500 for family coverage. They cannot cover services before deductibles have been satisfied. They can be provided by an employer or purchased directly from an insurer. Contribution rules differ for HRAs and HSAs. HSAs have strict limitations on contributions. The maximum contribution to an HSA is 100% of the annual deductible up to $2,700 for self-only coverage and $5,450 for family coverage. Individuals aged 55 to 64 can make additional catch-up contributions. HRA and HSA. What is the difference? HRAs have been in existence longer than HSAs, but HSAs are growing in prevalence. HRAs are only offered in employer market. HSAs are available to people who get coverage from their employer or who buy it on their own. The structure, legal requirements, and patient incentives can vary significantly between HRAs and HSAs. HRAs and HSAs are intended to work with health plans, but they are separate accounts. HSAs are often administered by financial institutions and not health plans. Stop-loss spending. It is important for patient access services personnel to consider stop-loss spending limit, not just the deductible amount. An HSA plan stop-loss maximum limit applies to all services covered by the providers in the HSA network. In HRA and traditional plans, limits may not apply to all cost sharing, often exclude mental health and pharmacy out-of-pocket costs. HSA stop-loss limits may not apply to services from out-of-network providers, or high limits may apply. Specific services may have separate benefit limits. Plans may only pay for certain numbers of visits or up to a maximum dollar level. Consumers pay any additional costs. These costs can be paid from a HSA, but this spending will not count towards the HSA deductible or the plan stop-loss limit. Managed care versus non-managed care plans. A fundamental difference between a managed care plan and traditional indemnity insurance, see Course 5 Understanding Insurance, is the managed care plan seeks to provide or contractually arrange to provide covered services. By being proactive in this manner, the managed care plan exercises some control over the access to providers, quality of care, and use of services. On the other hand, most indemnity plans have adopted many utilization features and employed control mechanisms such as pre-authorization and catastrophic case management typical of managed care plans. The differences between managed care and non-managed care plans are rapidly diminishing. Most managed care plans offer a range of health plans that incorporate varying degrees of utilization control techniques. Hybrid plans are health benefit programs that have features of indemnity or service plans, but the employment various utilization control mechanisms and/or provider networks established for prepaid health plans. For example, the provider of a group or a staff model HMO may be offered through a PPO program, underwritten by an indemnity carrier, a Blue Cross Blue Shield plan. In another example, a group or staff model HMO may supplement its own provider network by marketing indemnity and PPO coverage for the care rendered outside of its panel of physicians. Managed care insurance card characteristics. Generally, managed care insurance cards have the following information: an ID number, which is referred to as a member number, policy number, employee number, or plan number, an effective date, and copayment amounts reflecting the ER, clinic, or office visits. Approaches to reimbursement. All MCOs take advantage of certain concepts from indemnity insurance that must not be overlooked during contract negotiation. The most basic of these are assignment of benefits and balance billing. The managed care member. Assignment of benefits refers to paying medical benefits directly to the provider of the care rather than to the member. This generally requires either a contract between the health plan and the provider or a written release from the subscriber to the provider allowing the provider to bill the health plan. The MCO contract requires the provider to submit the bill and accept payment. Balance billing. Balance billing is the practice of a provider billing a member for all the charges not paid by the plan, even if those charges are above the plan's usual, reasonable, and customary UCR charges or are considered medically unnecessary. Managed care plans and service plans generally prohibit providers from balance billing except for allowed co-payments, co-insurance, and deductibles. Such prohibitions to balance billing may even extend to the plan's failure to reimburse providers at all. Physician fee schedules. Physician fee schedules are often structured using Resource-Based Relative Value Scale, RBRVS. The Resource-Based Relative Value Scale assigns relative values to each current Procedural Terminology, CPT code, for services on the basis of the resources related to the procedure rather than simply on the basis of historical trends. The practical effect is to lower reimbursement for procedural services and higher reimbursement for cognitive services. Determining reimbursement. The following are the four primary methods for determining reimbursement: fee-for-service, per diem, case-based, capitation. Fee-for-service is the traditional means of billing by health providers for each service performed in specific amounts. Some managed care plans pay for services on a discounted fee-for-service contract basis. The amounts may be a percentage of the list price charges or be set amounts per unit as specified in the contract. Per diem rates are usually intended to cover all inpatient service utilized while a beneficiary is in the hospital. It is common to develop more than one per diem rate. For example, it is common to have a different rate for medical and surgical patients. Or it is possible to negotiate one rate for the first 2 days of an admission and lower rate for the remainder of the stay. It is important to recognize that the majority of the resources are concerned in the first 48 hours of a hospital stay. Case rate. Medicare reimbursement introduced the concept of a case rate where pre-admission testing and inpatient services are reimbursed on the base of the diagnostic grouping into which the cases fall. There is a fixed dollar amount of reimbursement associated with each diagnosis-related group, DRG, regardless of the resources consumed. Some commercial carriers have adopted this methodology, negotiating flat amounts for certain types of cases. Payers may choose to negotiate global case rates for certain cases. That includes professional fees and home care services, as well as pre-admission and inpatient services. Capitation. The final reimbursement methodology is capitation. Capitation reimbursement involves a predetermined amount paid per enrollee. The provider is paid monthly for each enrollee assigned to the provider rather than being paid for the service used by the patient. This method represents a significant transfer of risk to the provider. Capitation is a form of managed care reimbursement calculated on a pre-need basis. It is the payment of a fixed sum of money based on the population of potential patient to one or more providers of the healthcare service who assume the healthcare risk for such individuals for a period of time. Capitation involves rate paid, usually monthly, to a healthcare provider. In return, the provider agrees to deliver health services agreed upon to any covered person. HMOs may negotiate capitated rates for any contracted provider service, and in fact, capitation is the most common method of reimbursement for primary care physicians. Capitation involves per capita per head based pricing for a defined level of service. What are carve-outs? A carve-out is a managed care lingo for a program that separates certain types of services or patient groups, most commonly in the area of mental health and substance abuse, collectively known as behavioral health care, and provides them separately, usually through a separate managed care behavioral health MBHC contract. Managed care carve-outs are tools used by managed care companies to provide their members with less primary gatekeeping and greater access to specialty care. There are two general forms of carve-outs: payer carve-outs and health plan subcontracts. Payer carve-outs. In payer carve-outs, an enrollee chooses a health plan for coverage of health care, with the exception of mental health, and must enroll with a separate carve-out vendor for mental health care. Examples of payer carve-outs include some state employees' health plans. Health plan subcontract carve-outs. In health plan subcontracts, administrators of the general medical plan arrange to have mental health care managed by a carve-out vendor, or MBHO. The plan member does not have to take steps to select the mental health care coverage. Examples of payer carve-outs include health plans associated with Prudential and Humana. Access management impact. Behavioral health care, mental health, and substance abuse carve-outs are estimated to cover 30% of the employer-based non-HMO plans to 50% of all patients insured. As carve-out billing is usually managed by companies other than patient's original payer, it is easy to negatively impact payment by incorrectly billing the wrong insurance company. In fact, a common reason for a carve-out denial is failure of the access management staff to notify the right company for the behavioral health admission within a timely manner. In such situations, carve-out companies may require notification of admissions within 24 hours or 1 business day. During that time, it is required to correctly bill the original plan and receive non-covered denial services if the wrong plan has been notified, which results in precious time being lost in notifying the right carve-out company. Access management personnel who are not trained to recognize this are increasing the incidences of incorrect notification, and that poses a financial risk. You have successfully completed this course. Watch to the end of the video so you can see the answers for the self-assessment quiz that you took earlier.